Hello, everybody. Welcome to Trucker Money number 68. If you're new here, we like to get together once a week and talk about something other than trucking because all trucking all the time. Who wants to do that? Let's talk about investing, taking control of your personal finances, making some passive income, making some money outside of trucking. So when rates get bad like they are, you might still have some money come in or some other things going on, right? Or maybe be able to leave something to your kids or your grandkids. It also happens to be one of my favorite topics is personal finance. So, and if you're returning, welcome back. Glad to see you. We all know it's hard to build wealth when you're driving half of your net worth and wearing the other half, right? You ever seen somebody walking around with a $50,000 Rolex when you know they can't afford it, or driving a $70,000 vehicle you know they can't afford? It's hard to build any meaningful wealth uh, like that. So here we talk about living a modest lifestyle and putting your money to work for you, even while you sleep. So one of my favorite things is earning money through dividends, dividend-paying investment stocks, things that pay me income. This week we received 3 different payments only. Stag Industrials Real Estate Investment Trust paid, ticker symbol STAG. Ticker symbol O, Realty Income, also paid this week. Both of those companies pay monthly, so this kind of a unique thing here. Not all companies pay monthly, most pay quarterly. And then ticker symbol MO, Altria. They paid. Their dividend is super high right now because their share price is down. Gives them about roughly a 9% dividend. Normally that would scare me away a little bit. We don't like them that high. It's a lot of times that's a yield trap, but they have a long history of paying out dividends. Usually they're right around 6 to 7%. That share price comes up, that dividend will fall back down percentage wise. So we're going to take that money while they're giving it out. Also this week, the only thing I put more money into was BMY, Bristol Myers Squibb. Bought a little bit more Starbucks. Now, if you've been around a while and you go way back, you'll know I've had a moral dilemma over Starbucks, and I've decided to take the position of a financial atheist and just let them do what they're going to do. Because you know what? The more I look around, you can find something that you don't like or something you disagree with just about anything out there. Literally, I look around, I could find fault with about any of them. So I'm like, you know what? Um, as long as they're not, well, hell, I don't know, committing genocide or something, we'll give them a chance, let them do their thing, and we'll take their money. Besides, I've grown kind of fond of their products here. I find myself buying overpriced coffee from time to time. Can't help it. It's good stuff. And then the other thing I bought was SCHD. Now, we did get a raise this week from Stag Industrials. They raised their dividend. They were the only company to raise it. But hey, I like getting money for doing just about nothing other than being a loyal shareholder. I like to earn that money while I sleep. So that's pretty cool. If you've been around a while, you know about this generational wealth fund I'm putting money into to try to build income and wealth for future generations of the family, not necessarily like kids, but maybe grandkids, maybe not nephews and nieces, but great nephews. I'm talking about 50 to 100 years down the line. Putting money away so that over 50, 100 years turns into serious money, right? And maybe we can change some future generations of what's to come in the family wise. So, maybe I'll be that uncle they look back on and say, uh, thank God for him, right? Anyway, I've been talking a little bit about that, and I talked about the only holding I have in it right now that I'm putting money into it is SCHD. It's the Schwab U.S. Dividend Equity ETF. Now, I'm just going to go through that a little bit here. Is that all that's ever going to be in there? No, absolutely not. But that's where I'm starting. And I'm going to bring it up on the screen here and I'm just going to go over it a little bit and I'm going to show you about it. I'm not recommending it to anybody, but I just want to point out some things I like and maybe some things I don't like about it. And then, maybe when you are looking at a different investment or something, you can learn to look at all the. By no means are we going to go over everything, but just take a look at some basics. All right, so we're looking at the SCHD, the Schwab U.S. Dividend Equity ETF. It's going to look at just the basics of it here. Share price, previous close was 76.27. Now, here's one of my favorite things about this ETF. Expense ratio, 0.06. That is super, super low. That's very low. Fidelity does have some funds with a 0% expense ratio, but I don't buy just strictly based off the expense ratio. There's many other qualifying factors, but just the fact that this fund that I like has a 0.06 expense ratio is just icing on the cake. The 30-day SEC yield is 3.56%, which is $2.60. Well, we're rounded up to $2.66 per year. Now, if we go over here, it gives you the top 10 holdings. Okay, here's one thing that I don't necessarily like about the ETF. That the top 10 holdings are 40.46%. I'd like it to be maybe not quite that high. That's a pretty good number of the holdings, the top 10 holdings equaling a good percentage of the fund. But it's only got 104 total holdings. So, I mean, it's not like you're looking at 300-400 holdings in here. Here, if you look at the performance, all right, now here's where I'm going to lose a bunch of people. And that's okay because we all do what makes sense for us and have our own goals and criteria. Now you look at this and say, Adam, this thing stinks. It's underperforming the market. And you would be correct. It underperforms. Its benchmark is the Russell 1000 value index. And 1 year for SCHD is 4.57%, and its benchmark is 11.46%. Now, historically over time, if you look at the 1 year and the 3 year, it's underperforming, right? If you look over, way back, 5 year, 10 year, lifetime, it's beating its benchmark. It's at 13%. Its benchmark is averaging 11.23%. If you look at it versus the S&P 500 for the last, I don't know, better than a year, it's getting beat pretty bad by the S&P 500, but that's not the index it's trying to track. In my opinion, it's lagging its index for the past year, a little better than a year, because in 2023 it did some selling and kind of some rebalancing. It booted a few holdings out and brought some new holdings in. Where you're also going to see that later is the turnover percentage. It's going to show up in the turnover. But I've said before, I don't necessarily go for highest return is not necessarily my only goal. I want income. And you'll see here where this, in a second, where that's going to point itself out. Here's the chart. Is there anything on this page? There's nothing on this page we want. Composition is the style box here shows it is a large value fund. And here's the sectors: industrials 17%, financials 16%, healthcare 15%, IT, information technology 12.55%. Now this is one of the things I do like about it. If you look at, oh man, a vast amount of funds on the market today, information technology makes up the #1 position in the fund. And that is not what I am looking for. I like that industrials are up higher. I like that financials are higher. I like that healthcare is higher. I like that these are all higher than IT. Okay. Now, your growth funds are going to mostly contain more information technology because that's where most of the growth is. Top 10 holdings: Broadcom, AbbVie, Home Depot, Texas Instruments, Amgen, Merck, Cisco, Chevron, Pepsi, and Coke. Okay, distributions and expenses, we already touched on this. It's about 3.5%. We jump down here. You can see that they have a decent history of raising the dividend over time. If you look down here-ish, right there, okay, which is something we're always looking for. Ratings, it gets a 5-star rating from Fidelity. Here it does show again the short-term sentiment is weak. Midterm strong, long-term strong. Okay. Performance and risk. Here you can see the growth of a hypothetical $10,000 over a little more than the last 10 years, I guess. From 2012, putting $10,000 in would net you, looks like right about $37,000 ish. Here, let me click on values. Yeah, $37,855, and oh, just about 11 years. So then we can look at the profile and objectives of the fund. It says this investment seeks to track as closely as possible before fees and expenses the total return of the Dow Jones U.S. Dividend 100 Index. To pursue its goal, the fund generally invests in stocks that are included in the index. The index is designed to measure the performance of high dividend yielding stocks issued by U.S. companies that have a record of consistently paying dividends, selected for fundamental strength relative to their peers based on financial ratios. The fund will invest at least 90% of its assets in these stocks. So that's a key statement right there that kind of drew me to this. The the holdings are selected for fundamental strength relative to their peers. It means they're picking the best of the best in each category, which is, you can take an S&P fund and you're forced to invest in all of those funds in the S&P, whether they are weak or strong, regardless how they're performing in relation to their peers, and that's what it is. So I feel like this fund is picking quality holdings that are going to be doing well over time rather than just going for max growth. They seem to place an emphasis on picking the best of the best or the higher quality companies in relation to their peers. So that's my primary thing. And then, of course, the income. So thanks for sitting through that with me. As that wasn't really an analysis, I'm just pointing out some of the things I like or don't like about it. When you're picking an investment, you got to do your own homework. You got to put, look at the numbers, way more into it than that. Um, just thought I'd point that out. That is right now what I'm putting in that generational wealth fund, and I may add to it. So the fact that the top 10 holdings are 40.6% of the fund, that's why I don't put all the money in one place. You spread it around. So I'm going to complement that with something else eventually. For now, I'm just focusing on that, building a position in that, and then we'll add to it later. But at any rate, a short one today. Got to go. Everybody take care, and we'll see you next time.